Hello and welcome to our discussion on accounting for convertibles. We will see the accounting for convertible debentures in this session. To recap, in case of convertibles like convertible debentures, one has to use the split accounting according to IAS 32. The value of the debt at the time of initial recognition, that is the convertible debentures or the convertible debt, should be divided into debt and equity, and the value of the debt will be determined by using the present value of the bonds and the present value of the interest, and the discount rate generally will be used as the market rate of interest without the conversion option. So the value of the equity is a residual value, and the debt will be shown at an amortized cost. So therefore the changes in the value of the debt will be shown in the income statement. However, the value of the equity will not change, because the value of the equity is not treated as a financial instrument. So in this session we'll take an example to understand the effect of the issue of the convertible bonds on the financial statements. So as usual, we have a opening balance sheet, and the company issues 200,000 convertible bonds of 1,000 each, convertible into one share at the end of the 4 year. And the coupon rate conversion feature is 9%, and the other transactions are the sold goods and there's a depreciation of 10%. Let us put that in the Excel and observe it. So the opening balance sheet of the company, as we can see, that capital 210, retained profit 350, creditors 200, creditor 25. So capital 210, the retained profit 350, creditors 25, supported by cash 85, debtors 200, stock 200, and plant 100. Cash 85, debtors 200, all are in million, stock 200, and plant 100. So that is the opening balance sheet. So the opening cash in hand in the cash flow will be 85. Now with these items, they go for the issue of the convertible debentures, 200,000, coupon rate 6%, convertible into shares, and the 10%, the coupon rate without conversion is 9%. Coupon rate without the conversion feature is 9%. So the number of convertible debentures 200,000, the price is 100,000, so therefore the total value in million is 200. So the company issued debentures, convertible debentures of 200 million. The term is 4 years, interest rate is 6%, coupon interest, coupon rate, convertible into one share, and the prevailing market rate of interest without the coupon is 9%, and we assume there are no expenses now. So since this is a convertible, we have to split that convertible debenture, and the splitting is done by finding the value of the bond first, and then the residual is treated as equity. So the bond present value, the value of the bond present value will be, well, computing the present value, we have to take the coupon rate without the conversion feature. So the present value of the bond is 141, and the interest is calculated an actual. The actual is 6%. So interest all 4 years is 12 million and 12 million, and the present value of this interest will be once again discounted at the coupon rate without the conversion feature will be 38.88. So the value of the bond is a PV of the bond and the PV of the interest, and the equity is the remaining balance. Now this is what they've issued. So during this period, if they've raised money, instead of writing the entire amount as bonds, we will record 180.56 and equity as the balancing figure, which is 19.44. So in the balance sheet of the company, we show the bonds and we show the equity acquired during the year at 180 and at 19.44 respectively. So instead of writing one item or recording convertible debenture, we are splitting the debentures, we are splitting the convertible instrument, into bond and equity. So now we'll get into the other transactions. The other transactions, they've sold entire stock for 350. So sold entire stock for 350, and let us assume that that is for cash. So therefore entire 350 will be a cash inflow, and the corresponding cost of goods sold is 200. So the stock will not be there anymore. These are our regular transactions. And depreciation is 10% of the plant, so 0.10. No cash flows, but the value of the asset comes down to the extent of 10. Then we have to show interest, but to calculate interest it's better to make an amortization table. So the amount of amortization, the amortization table will show the effective rate of interest. The effective rate of interest is the internal rate of return, which will make the present value of the cash flows equal to the or the net present value to be 0. So at the end of the year, you are paying 214, 212 in the fourth year. So the effective rate of interest is the IRR of these cash flows. So IRR of these cash flows, once again, IRR of these cash flows minus, so IRR of this cash flows, the effective rate of interest is the internal rate of return of, so that is 6%. Okay, oh, we are not wrong. 200,000 we are raising 200. Okay, we'll not take 200, we take the value of the bond, and the value of the bond is 1, and we are repaying at 112. So the opening amount is 180.56. Every year we calculate the interest on the basis of effective interest. So the coupon rate of interest is 12, we already calculated. The closing balance is opening balance plus the effective interest minus the closing interest, and the closing will become the opening. The interest will continue to be calculated at interest will be calculated at the effective rate that is 9% here. I take that 9% as constant and pull it down. The actual interest paid is 12, so the closing balance once again goes up, and the amount of interest paid is 12, the closing balance accordingly, the amount of, okay, so yes. So this table shows the amortization calculation, or the amortization table will show the effective interest calculated on effective rate of interest, and also the coupon. And this is the closing value or amortized cost of the bond to be shown on the balance sheet every year. So the interest that I have to show is I'll show that as a coupon interest, but the change in the value of the bond, if you see that we issued the bonds at 180.56, by the end of the year, the increase in the bond, so I'll say increase in the amortized cost, is 184 minus 180. So the bond value went up, so it is a loss. It is a loss, or it will be shown in the income statement. Okay, income statement. So the value of the bond will, by the end of the year, will become 184.81. So all the other transactions taken care. So the profit is equal to, for the period, profit is equal to the sales minus expenses. Profit is equal to sales minus expenses. If no information given, we put the retained profit. We include that entire profit into retained profit. During the period you paid interest, so we assume that interest paid. So therefore cash in hand is equal to 635 minus 12, and that becomes the cash in hand for the balance sheet, 623. No change in the capital, no change in the creditor, no change in the debtor, and no change in the stock except the sale. Okay, no, so your balance sheet tallied. Okay, so in the second year we continue with the transactions. No sales, no cost of goods sold, only depreciation, interest, and changes in the amortized cost. So I pull the, so therefore no sales, no cost of goods sold. So the depreciation is 10% on the original cost of 90, and we charge that. As we have already discussed, interest will be 12, and the amortized value of the bond, because we already calculated from the amortization table, and the increase in the change in the value of the bond will be booked in the income statement. So there is a loss of minus 26 million, and that will be transferred to the income statement. No change in the cash flow, because 623 is the opening, and no incomes, no inflows except interest for the period. So 611 is the cash in hand. 611 is the cash in hand. No change in the debtor, no purchases and no sales. So no change in the equity. So your balance sheet for the third year, 208, is done. In the same way, we can also show the expenses and incomes of the other years. The depreciation we are continuing to show as 10 all the 3 year. Interest, the coupon rate of interest will be shown. The value of the bonds, the value of the bond is 194. So increase in the value of the bond is, let me increase the, so okay, and increase in the bond will be shown as an in the income statement as an expense. No change in the equity, so the loss is minus 27. So therefore the value of the retained profit gets affected by that. No change in the creditor, and in this year 2 the opening cash is 200, no other expenses or outflows, so the only outflow is the interest, so the cash in hand is 599, no change in the debtor, no change in the stock, and the asset value reduces to the extent of 10, so therefore the balance sheet is done. In the last year also no incomes other than no sales or no COGS, but expenses other than depreciation, interest, and the change is not there. So the value of the bond before the redemption will be 200. So therefore the increase in the value of the bond will be booked in the income statement. No change in the equity. The loss will be booked into the retained profit, and no change in the capital. Creditor, no change, and the cash in hand will be cash in hand. Only the change is the capital, the interest. So the cash in hand 587, no change in the debtor, no change in the stock. The value of the plant reduces by 10 million, so 847. So at this juncture we assume that the bonds have not been converted. The value of the bond, if you see, slowly increased to 200, and the value of the equity we maintained at its same value which we determined at the beginning, because the equity is not a financial instrument, so you don't have to make the revaluation or show that as a fair value. But now if you are going to issue, the conversion takes place and issue shares to the bonds, then entire bond will become the equity or converted to capital. For the sake of discussion, let us assume that entire bonds are converted to capital at the face value. So we are going to increase. So let me write down here conversion. Okay, conversion. So 200 to 100. So the capital will increase by 200. Capital will increase by 200, and the bonds will decrease by 200. Bonds will decrease by 200. Equity will remain on the balance sheet as equity, maybe as a separate item. So to recap, as we said in a convertible debenture, at the time of this issue you have to find the value of the bond as a present value, and the present value of the bond is 180 million. The corresponding value, the residual value, is the equity, and the residual value here is 19.44, and the bond will be used to calculate the effective rate of interest. An effective rate of interest is the internal rate of interest, internal rate of return calculated by taking the cash flows on the bond, notional amount of the bond, and the equity will continue to appear at the same value because it is not a financial instrument, whereas the bond value will keep on fluctuating because of the amortized cost, and the change in the value of the bond will be reflected or booked in the income statement. That is different from if you don't show the conversion and just show the bonds as the bonds on the balance sheet. So in a split accounting, the amount of the convertible bonds or convertible preference share has to be divided into the compound instruments, that is the debt and equity, at the initial recognition only. Thank you very much.